I'm going to go ahead and start with some opening remarks. There's only two things on people's minds today: making ends meet and making meetings end. So we're going to do our best to stay on schedule. Welcome to the Hospitality Law Conference, Washington, D.C., Day 2. Today is September 17th, 2025. Welcome to those of you here in the prestigious Army-Navy Country Club in Arlington, Virginia. Welcome to those of you watching live but remotely, and welcome to those of you that might watch this program on demand in the future. My name is Stephen Barth. I'm the founder of HospitalityLawyer.com and a professor at the University of Houston. I'd like to say thank you to Kensington Vanguard, the National Title Company, for their generous support for our breakfast today. Let's do a quick safety and security review. Yes, thank you. Let's do a quick safety and security review. There is not a fire drill scheduled today in the club, so if a fire alarm goes off, it's the real thing. Just please keep in mind that the elevators will not work. There is stairs, as many of you probably saw as soon as you came in, will take you right down to the lobby. But if you also exit any of the doors at the back of this room, you turn left, go straight out to the terrace. There's an exterior staircase that will take you down to the ground level. So, and restrooms, by the way, are just outside and to the left of this room. We do a lot of social engagement at HospitalityLawyer.com, so I hope you'll join us today in sharing the information. And those of you that are watching remotely, you are welcome to do so as well. By joining us today, whether it's remotely or here in person, you have access to HospitalityLawyer.com for 1 year. You can scan this QR code, and that will get you to the place where you can create a complimentary login that will be good for the next year. We also are very proud of our collaboration with MyLawCLE, a national CLE provider for the lawyers in the room. We have also created, in conjunction with MyLawCLE, a hospitality law portal. So now you can access all of your CLE relevant to hospitality at MyLawCLE. That QR code will take you to a spot for you to sign up and purchase access to MyLawCLE. For attending this program, as well as yesterday, there is continuing legal education credit available. Everything is really straightforward except for Virginia. Those of you that practice in Virginia, you know that. But if you have any questions, please see Marilyn and or the MyLawCLE folks here at the audiovisual table. So Day 2 of our program, this half-day program, is focused on Let's Make a Deal. And so let's just take a quick peek at what we're going to be doing this morning. We're going to start with some opening remarks and then the market outlook for Panel 1 and deal-making trends. Then we'll roll into Panel 2, an anatomy of a hospitality acquisition in today's current market. We'll take a quick break supported by Cozen O'Connor. And then we'll come back for Panel 3, Financing the Future, and Panel 4, Legal Landmines and Successful Outcomes, followed by a dealmaker's reception out on the beautiful terrace, supported by Ancora, Dimension Hospitality, and Fisher Phillips. Now, to start us off, to give us just an overview of the deal landscape as it exists today, is Mr. Bradley Burwell, Executive Vice President of Colliers.
Good morning, everyone, and thank you to Stephen and Hospitality Law Conference for inviting me to provide a brief overview of the current deal landscape as an introduction to today's panels. We have a distinguished lineup of experts who will explore hotel transactions, capital trends, and deal structuring throughout the day for you all. But to set the stage, I'll outline the current transaction environment and highlight just a few key trends. Can we do the slide? There we go. Perfect. There's a lot there, I know. But just to kind of summarize, in 2024, approximately 1,700 hotels sold throughout the United States worth $25.5 billion. In the first half of 2025, 823 hotels have traded hands worth nearly $12 billion, aligning with the first half of 2024. Over the last year, we've seen a 4.5% decline in total hotel sales volume, but about a 25% drop in the number of properties sold. And looking at the market with a broader lens, I would say sales volume in the last 12 months is 32% below the 15-year annual average, which is about $36 billion a year. I'd also note that although the third quarter's numbers are not out yet, the 12 months as of September will likely be down another billion or two. Regionally, I have some statistics up here that transaction volume across the United States remains well below historical averages. The South and Midwest have experienced the smallest declines and even shown year-over-year increases. This reflects post-COVID investor shifts towards Sunbelt markets, coupled with less volatility in the Midwest smaller markets, which are less impacted by macro trends. Conversely, gateway cities on the East and West Coasts have experienced significant turbulence over the last 5 years and are, in my experience, much more volatile investment markets anyway. Another notable shift is the decline in the average deal size over the past 24 months. While a typical hotel sale or a typical sale of an individual hotel hovers around $15 million, and it has for, as far as I could tell, 7-8 years, the average deal size has fallen 30 to 40% recently. You can see this as portfolio volume is down more than 45% from historical averages, and we haven't seen an entity-level transaction in the last 20 months, which is particularly important to this group. I'm going to simplify the complex transaction market into two factors. First of all, the types of capital, both buyers and sellers, and the cost of debt, which brings me to the next slide, capital trends today. Our third panel, Financing the Future, will delve into equity and debt capital and talk about this a little bit more, but I'm going to highlight just a few insights. This big graph that looks very colorful shows buyer capital sources over the years, and it illustrates a cyclical pattern, even though it may not at first glance. Sellers on the other side of deals are consistently mixed, so I haven't put them up here. I would say an apocryphal statistic that I heard years ago states that 80% of hotel investors lose money, while the remaining 20% make a lot of money and recoup all of the 80%'s losses. And if that's true, private capital, which is owners, operators, high net worth family offices, are all a meaningful part of that profitable 20%. You can tell that they tend to buy when transaction volumes are low and performance is down during crises like the Great Financial Crisis, COVID, or one could dare say today. By contrast, cross-border and REIT capital tend to invest when asset performance is strong. Interestingly, I would note that these groups are the right buyers when debt is expensive and operating performance is weak, as they use low leverage and they are long-term holders. However, they rarely invest in downturns. REIT stocks are often lower when interest rates are higher or the economy falters, and international investors pull back capital with negative economic trends globally and favor fixed income when interest rates are high. I would note that between 2019 and 2024, REIT acquisition volume is down 46% from the levels seen between 2010 and 2018. So they're doing half as many transactions as they were really pre-COVID. Host was not rewarded by the public markets for its excellent acquisitions in the last 24 months, both in New York and Hawaii, and even in Nashville. The major asset aggregating REITs of the last 10 years are all but silent or else in sell mode. Braemar, as everybody I'm sure has seen, and maybe some of you are participating in, is on the market as shareholders recognize that its assets values exceed the public valuation. And just this week, one of Sunstone's largest investors requested the company to start asset liquidation. From a cross-border perspective or international buyer perspective, each cycle has always had a dominant foreign player. The Middle East came out strong in the early aughts. The Chinese, and specifically Chinese insurance companies, came out in the early teens. And since COVID, we've seen investors from the UK, from Canada, Singapore, and Korea, who have all tested the hotel market for various reasons, but not one has emerged as a dominant force. I'm hoping that in today's panels, somebody will shed light on who the next major foreign investor is going to be so that I can call them later. Finally, institutional private equity emerges cyclically, I would say like a cicada. Private equity value often hinges on cheap debt. Recessions, downturns, crises lead to this cheap debt. And as you can see, after the great financial crisis and COVID, which are marked there with some red arrows, institutional equity funds become the largest investor in the space, deploying significant capital in a very quick period, and then they dig back in and wait for the next cycle. So now that we've gone through a couple of years of low transaction volume, are they going to come back out? We've seen, obviously, Blackstone make a major acquisition down in Miami last week, and earlier this year they've made several pretty big deals, so maybe that's a sign. Let's go on to the next slide, please. In my, frankly, oversimplification of the transaction landscape, debt is the second key factor. And today's debt markets are both liquid and more constructive than the equity markets. Lenders seek stable, predictable income that thanks to high interest rates, they're enjoying the strongest yields in the last 35 years. Lenders are much more mathematical in their analyses than equity investors, and we are at an interesting point in the cycle where we are seeing lenders value assets greater than buyers. This little chart that I put up here that I guess it's not too hard to read shows average hotel cap rates by year. And currently, investors value hotels around a 9.5% cap rate. This is compared to a historical average that, even though it doesn't look like it, I would argue is about 8.5%. Mr. Lesser will have a much better opinion of that than I do. But lenders are still underwriting the value of hotels on this historical average. And that means that they are valuing assets 10 to 12% higher than buyers are today. And as a result, lenders are often offering borrowers 72 to 75% of loan to market value, yet they're pricing it on the appraised value and on a loan at 65% of the appraised value. Next slide, please. I just want to hit on a couple of other macro trends that is impacting underwriting for investors today. First of all, travel trends. Remote work from hotel rooms during long weekends, which was driven by Zoom and flexible office policies and demographic shifts, has all but waned. International tourism to the U.S. remains below pre-COVID levels, with fewer high-spending, long-stay visitors. This trend, I think, is going to continue with both rising visa costs, inflation, and global sentiment. On the upside, airport traffic, as reported by TSA, continues to rise steadily, indicating corporate travel continues to rebound. I will tell you that last night my flight was delayed. I did a red eye, and the plane was totally full, and I couldn't get a bag in, and I was in boarding section 1. So that just goes to show how crazy it is. And it also tells me that a lot of frequent travelers are traveling, which is typically your business traveler. In terms of labor, inflation and constrained low-wage labor pool will continue to pressure operating costs. And then in international relations, which I think is much more about stability. Market sentiment shifted rapidly with initial optimism at the start of 2025 that faded by April, and although uncertainty persists, confidence is gradually returning. And by early next year, I believe that geopolitical concerns will have a smaller impact on underwriting as investors and lenders adjust to what we could call new norms. Go on to the next slide, please. Our first panel today has a great set of advisors that are going to be talking about the market outlook and deal-making trends. But before we move into that in just a couple of minutes, I want to outline a few ideas and topics that we are seeing from investors, buyers, and lenders today. First of all, what do investors want? Geographically, they are still particularly focused on politically red cities with major medical, educational, sports, and entertainment venues. From an asset perspective, I would say that cash is king. Stronger in-place income attracts more interest. Today, investors prioritize assets that cover debt service without requiring additional capital rather than repositionings. And then finally, deal sizes, as I mentioned, are currently smaller, but I anticipate that in 2026, we will see more substantial transactions, both single asset, more portfolio deals, and then the thing that's really going to push the size of the deal is we will see a return of entity-level transactions. How is underwriting changing? Our second panel, Anatomy of a Hospitality Acquisition, will explore this. But I'll note that the cost of equity has risen over the past 2 years. Leverage IRR targets today are now in the low 20s, up from the high teens at the end of the last decade. And then finally, the word that perks everybody's ears, distress. Everyone wants a distressed deal. I think that this is so much so the case that buyers typically overpay for distressed deals. Well, let me just set the stage here. CMBS delinquencies increased from $3 billion in the fourth quarter of 2023 to over $5 billion in the second quarter of 2025. Furthermore, 8% of loans are currently reported to be distressed, which is the highest level not since COVID, but since 2010, since the great financial crisis. There are two types of distressed deals, those that are operationally distressed and those that are overcapitalized and financially distressed. Operationally distressed deals are relatively consistent. They're functionally obsolescent hotels, and those just are naturally kind of coming all the time. And I used to point out that almost all of the distressed deals purchased in 2021 were distressed before COVID. But to many investors' excitement, and I'm sure to many of you, to many of your clients, we are now seeing bigger cracks in the dam holding financially distressed deals back. These are the deals that were built for too much money. They were the deals that worked when debt was 3.5%. Hotel operations have generally stabilized across markets, and although the cost of debt is expected to continue to slowly become less expensive over the next year or two, it is not expected to fall dramatically. And these factors are leading lenders to call in their loans. They are productively working with borrowers, as we have seen, because they don't want the assets back, to either sell or refinance these deals in an efficient manner. That can be achieved by allowing the borrower to control the process if it's a short sale, working to alleviate tax implications and financial burdens for the borrower, covering operating shortfalls, obviously, and we are seeing consistently that These lenders are providing some type of bridge loans to buyers or anybody who brings in fresh equity. With this broad overview, I'm going to pass the stage on to our moderator today, Stephen Shapiro. Stephen directs the Hospitality and Tourism Law Program at American University here in DC, and he teaches courses on industry economics, franchising, development, data security, risk management, and employment law. Stephen and Stephen Barth, our host here, collaborate on hospitality lawyer events and teach together in France. I encourage all of you to reach out and to connect with them about upcoming programs and also ideas of future programs. With that, I wish all of you a fantastic day, and hopefully it will get sunny for the terrace this afternoon. Stephen, the floor is yours. Thank you.
Hi, good morning. I'm going to ask our panelists to come up for the first session. We have Jared Allen, Dan Lesser, Hector, and Kyle Stevenson. For me, our session, which was a great setup by Brad, has three sort of overarching topics. It's let's make a deal, so acquisition of properties, and then along with that, we'll have a conversation perhaps on franchising. We're going to be looking at funds. Where's the equity? Where's the debt, which Brad talked about also. New development, and then our final session will be on, it's on risk, but it's also going to be gremlins. Where are things hiding? I'm going to ask our panelists to introduce themselves, but I'll ask them, we have our next panel. So Dan's going to stay. I'm going to, and so is Kyle. Thank you, Jared. Thank you, Manuel. Going to invite, very good. Okay, our topic is acquisition. I'm thinking of a couple items extending from panel one. For our panelists, I'll have the new speakers introduce yourselves. But are we talking about conversion? Are we talking about new development? Jennifer will be talking about legal concurrent paths to acquiring. Dan and everyone else will be talking, I think, about how you investigate the brands and management companies. But first, Jonathan, can you introduce yourself?
Hi, good morning. Jonathan Fallick, happy to be back again. I'm going to try to do this really fast. I'm originally trained as a CPA, an investment banker covering the hotel industry. I ran the hotel investment sales business at Newmark. I ran the hospitality investment banking business at Cantor Fitzgerald. But the best thing I did was found JF Capital Advisors 21 years ago. Similar to Dan, I came up with the JF name in about 2 days after I left Bear Stearns, and I had some clients that wanted me to sign engagement letters, so I came up with a name. We've completed $35 billion worth of transactions, acquisitions, dispositions, restructurings, mostly messy stuff. Asset managed over 135 hotels. Mostly we do things that are complicated, a lot of restructuring, a lot of recapitalization, and on a sponsor basis have led the acquisition or development of 25 hotels around the U.S.
Great. Jennifer?
Good morning, everyone. My name is Jennifer Nellany. I'm a partner at Cozen O'Connor, based out of our New York office. My focus is on, I'm in the real estate group, but my focus is on hospitality, so I do probably most of the hospitality work that comes through the firm. Prior to that, I was the general counsel for Morgan's Hotel Group, and I was the general counsel at Tishman Hotel and Realty. And I've had stints at other real estate companies, but I originally started my career as an M&A lawyer with Fried Frank and did the Lehman Brothers buyout of the Le Meridien hotel chain, which made me an instant hotel lawyer. So that was a long time ago, if you know when it was. I've just dated myself. But it's nice to be here and nice to see Steve.
Good morning, everyone. Manuel Vermont. I'm a managing director with Ancora Consulting. I'm based out of Dallas, and primarily we focused on advisory services and consulting in the areas of strategy, M&A, transactions, restructuring, asset management, interim management. You know, Dr. Bart, thanks again for the invite. For those of you that may not know, he was my law professor at the Hilton College of Hospitality Management in Houston.
And you came
So
back.
please don't ask me any law questions. But I spent about 15 years with Alvarez and Marsal prior to Ancora. I was fortunate enough to be involved in one of the largest corporate bankruptcies in the world at Lehman Brothers for 3 years in New York, and started with Ancora roughly about 5 years. So glad to be here, and thanks for having us.
Great. Kyle, start with you. There's another mic to your left. Let's take an acquisition of a full-service hotel. The buyer intends to reflag it from Marriott to Hilton. Start from your end. I'm going to ask Dan about investigating which other flags, but what are the first steps and when are they engaging legal counsel and finding money?
So the question is, when someone's taking a full-service hotel, moving from one brand to another, specifically you wanted to talk Marriott to a Hilton.
It can be anything. There's going to be a PIP. There's going to be some renovation. It's going to be, it's a real deal.
Right. So the first question that comes out of our mouths is, what's the status of the current franchise? Because there's an obligation to that franchisor that is continuing and has requirements that need to be addressed if there's going to be a change. Change is great. People like to do value add, reposition. Oh, it didn't work as a Marriott, now I'm going to make it a Hilton, or it didn't work as a Radisson, now I'm going to make it a Hilton. But oftentimes the new brands won't even talk to the existing owner because of a fear of tortious interference, which is a
We
phase
can
that
assume it's in the last 5 months of the franchise agreement.
if you're going to do that, then I think you wouldn't have that fear, okay. But I think the big question is going to be, how will the hotel do? What will make it better? Why is this going to be a positive change, and why will the investors see a positive impact out of that?
Dan and Manuel, your clients have come to you, unless you have something, but your clients have come to you and said, we got this great property, we don't want to be a Marriott, we're looking at Accor, Hilton, Hyatt, IHG. For both of you, how are you helping and a new management company, how are you helping your client?
It's an interesting question because we are right now, my colleague Peter Crissati, who's sitting up here, and I are in the middle of a mandate right now on a portfolio of hotels that have a brand, but it's really not a brand. I can't identify the name. At the end of the day, they're exploring repositioning these assets with some sort of identity so that they can ultimately exit the portfolio. And we are running a process as we speak for brand and management, separate and apart. You know, your question, Marriott, Hilton, Hyatt, right? I mean, it used to be that Marriott was Marriott and Sheraton was Sheraton, right? Today, Sheraton is by Marriott, right? So the first thing you need to figure out is, okay, out of the family of brands, right, Arnie Sorensen, you know, let him rest in peace, that famous line of there's enough swim lanes for all these brands. I'm not sure about that then, and I'm surely not sure about it now. You know, the first thing you need to figure out is, well, first of all, what's in the immediate radius of the subject property, right? Because a Marriott brand may be ideal, but if it's not available, there's nothing to talk about. So you got to go to the next, you know, the next one, if you will. So yeah, I mean, it's a complicated process. I will tell you that, and this, I say this with the highest level of respect for attorneys. I find that it's much better off folks like us negotiating business terms and then bringing in counsel to document those business terms.
I'll ask Jennifer that question in a minute. I'm sure she'll have a reaction.
And really, the lawyers are really getting beat up on.
Sorry, I didn't mean to offend it.
Manuel, same question. Your client comes in and says, I'm got Kyle, I found a deal. It's going to be a Conrad. I know it. It's got to be a Conrad. And you need to maybe talk them down to the realities of the market. How are you dealing with your clients?
Yeah, no, it's critical because at the end of the day, the economics need to work. And so if you're thinking of a specific brand, but it comes along with the need to secure, key money for the brand because, it's part of making the numbers work out, or if there's a significant PIP associated with the conversion to the new brand, then, regardless of what the buyer, or in this case, the owner wants to do, all of that needs to work out. I mean, a lot of times, even though a brand may be available in the marketplace, that doesn't mean necessarily that it won't cannibalize with other brands from the same family of brands. And so that's also something, there's all, and you can talk about the legal side of it, but there's all the radius restrictions, protections on the management agreements and on the franchise agreements and what have you. But at the end of the day, you have to make sure that the product that you are bringing into the market makes sense for what the market needs, and it doesn't end up being something that, shoots you on the foot by just switching from one brand to the other that ultimately is not going to make a big change.
When we
I'd like to just
Dan.
tap into what you just said about key money. I don't know. I find that key money can very well end up being the most expensive money in your capital stack. So, the fact that people, throw this around, that's great, but I would look twice before accepting key money.
Well, and I think the part of the reason for it, at least in my experience, is that in many instances, that key money note travels with the next owner. So sometimes even if, let's say it's a $3 or $5 million key money note, and that property sells before that note is completely expired, whatever that balance of the key money note that is still not forgiven, quote unquote, transfers to the next buyer. And I know so because we had to negotiate pretty hard with one of the brands to forego whatever the balance of that key money note was when we were acquiring a property a few years back.
Jonathan, your services for acquisition?
So we do everything because we've been sponsors. But let me try to quickly address a few of the things that have been said. I agree with everything, but I want to add on a little. One of the things we didn't address yet on change of brand was the brand managing? Was it an independent manager or brand manager? And then what's going to happen? Where we see the best opportunities for future improvement is if we're going from brand managed either to within the same brand family with independent management, or changing to a different brand but with an independent manager. And there was discussion of a PIP. For anyone who doesn't understand, PIP is the property improvement plan, the brand mandated CapEx that you have to do in order to be compliant with the brand. And the PIP document itself is a scope document, right? The brand inspector goes with a checklist and says, you must do this, 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 this. You must replace this, this, this. You must repair or make like new this, this, this. They don't put a dollar number on it, but it's attached to the franchise agreement, which is guaranteed. So if you fail to do the PIP, you're going to be in default under the franchise agreement and likely default under your loan. So you got to pay attention to what the PIP is and when you agree to it. In going through kind of the process, when do you engage counsel, right? I usually err on the side of getting counsel involved earlier. That doesn't mean we need full-blown anything. But the worst situations I've been in are when someone comes to me and says, we negotiated a term sheet with Marriott, and now we need you to negotiate the franchise agreement. And I'm like, I can do a little bit for you, but you've got a signed term sheet, like, that's the deal. That's the deal, right? Same thing. If you're negotiating with a brand who's going to do management, that's the deal. So I don't think you need legal counsel to kind of talk generally about the business terms, what you're going to have. But if you're going to sign a term sheet and you do it without counsel that knows what they're doing, right, you made a big friggin' mistake. Big mistake.
I had a
And what you might want to mention, too, about PIPs, they're highly negotiable, right? Just because the inspector came in and checked all the boxes, right, that's great. But I guarantee you that if Blackstone's negotiating with any one of these brands a PIP versus Dan Lesser, solo, owner, right, they're going to get a much better
Yeah,
agreement in
and
terms of
absolutely.
what gets.
And the best way to do it is to have someone who knows where there's leeway, where the brands are going to be sticklers on things, and the PIPs themselves are, again, they're scope documents. They don't say like, oh, you have to spend $20 million on this. The brands don't care if you spend $4 million or $400 million. Right, if you do the items, and some of the things you can come in and say, we don't need to replace all this furniture. We can restain it, we can polish the tops, we can do X, Y, Z, right, and save millions of dollars. Or like, hey, your standard says we need an extra chair in the corner of these rooms. These are relatively small rooms. We don't need the extra chair, and that's going to save you $500 times 200 rooms in the hotel. So you want to do as much of the PIP negotiation as you can up front, right, before anything gets signed. But I've worked on, between my asset management business, ownership business, and advisory business, probably 300 PIPs for all different kind of brands, all different stuff. There's not a single one that we didn't go, once we started the work, and do some changes and renegotiation, right? Once you get into design, and planning, and pricing, you go back and say, this is sort of stupid, it's going to cost a lot, here's what we could do instead. And, depending on which brand and your relationship with them, you can get a lot of that done if you know how to ask and how to present it.
And the last thing I would just throw in, and then timing, right? Cash flow is king, right? So if you have to do something, right, obviously a dollar today is worth more than a dollar tomorrow. So to the extent that you can negotiate when you have to do what, is going to affect your economics as well.
Well, just one last thought, and I know we're focusing a lot on PIPs, but it also depends on which side, in the context of an acquisition, right? It also depends on which side of the table you're sitting at. Because if you're Blackstone buy-in and there's a PIP scope, as Dan mentioned, there's a good chance you'll be able to negotiate the scope and work with the brand in terms of what can be done and versus what should be done. But if you're the seller and you're just an individual seller with a change of ownership PIP, the brand is going to say, this is the PIP, and if the new buyer wants the franchise with me, this is what it is. And so your ability to negotiate that change of ownership PIP is much less than whatever the buyer has.
There's also generally a pretty big spread on what a seller, right, an existing owner, thinks the PIP will cost, right, versus what it's actually going to cost, right? Sellers are going to underestimate what it is. They're going to say, this is pretty good. Like, we're doing well in our quality assurance inspection reports. Our guest satisfaction scores are good. Yeah, there's going to be a PIP, and there should be some upgrades, but you don't really need to do this, 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 this. And, like, we would negotiate most of these things out. And the buyer, right, unless they can get a waiver or unless they can get something negotiated out of the PIP, they're technically required to do it.
When we come back to Kyle, first we're going to go Jennifer, back to Kyle, we'll talk about PIP. Jennifer, I had a reaction. You probably had a reaction. I know, Jonathan, you have a newbie client who comes and says, I have a Marriott brand managed deal for whatever hotel, JW, and your lawyering has become Scribnering. There's so many deals or provisions you can change. I'll let you comment on that. I think of what you or your firm representing a client is going to need to do the purchase and sale agreement, franchise agreement, maybe a management agreement, joint venture with your equity, with the client's equity partners, a debt financing, and as part of the franchise, you're going to negotiate area of protection.
Two more. Also at the beginning, an LOI and an access agreement.
Great. Go ahead, Jennifer. Take any of these you want.
Well, I think it was interesting to see how everybody sort of went down the line. I mean, I would have started also with the tortious interference. That's number one. And, and then I would have gone to, what brand can go where, the radius restrictions. And then I would have gone to who's giving me the best deal on the brand, right? And then once you pick a horse, based on all of those things, and you do the analytics, and I do agree that the lawyers shouldn't be involved in the beginning, but I do think you should have the lawyers involved before you sign the term sheet.
100%. And if you don't, you're stupid.
Right. And I will tell you, because I am currently representing someone. It's a ground-up development, so it's not an acquisition. and they have a Marriott brand management agreement, hotel management agreement, and it's it's a small group. It's a high. It's in a very valuable area. Marriott wants this, but they still don't have any leverage. And my guy is getting completely railroaded by Marriott. They won't say yes to anything, but he wants a termination on sale. And I think everyone in this room knows exactly what Marriott told me about getting a termination on sale. And the fact that he's just a small player is no shot, and it also wasn't in the LOI. So had he come to me before, I could have told him, if you really want this, you're going to have to negotiate with them. And he's not a sophisticated hotel investor, so he doesn't understand what goes into. So you want this done in like a week. And if you want it done in a week, we can get it done in a week, but you're just going to have to cave to everything that Marriott tells you to do. But you should be negotiating all of these things and the PIP, before you get in and then to the PSA. And the PSA should be negotiated simultaneously with these steps. And because as you're doing that, and I agree with someone on the previous panel that the PSAs are taking a long time because the buyers have all the power and they're just using the time for due diligence. They know there's nobody else out there. They know there's not tons of people. What am I going to do? Walk away?
Before we go to Dan, I'll add two more perhaps. If it's new, it's going to have zoning challenges. You're going to have probably local counsel working on zoning. Yesterday we had a session on ABC, alcoholic beverage. That's going to be a path that needs to be paid attention to. Dan, then we'll go to Kyle.
Go ahead, Kyle.
What was the question? Sorry.
Oh, question is, you typically represent the seller. I think Jonathan made a comment about the PIP. How are you working with your client, the seller, on presenting the deal to the buyer?
Presenting the deal? Is it that?
Yeah, generally, you're representing your client, but you want the deal to happen.
Right. So I think from going back to our hypothetical example here, the full service side of it, we have all these factors coming together. The idea really is to give the buyer the tools that they need. And someone was saying earlier to kind of have all these things teed up in advance so it's easier to go kind of a one-stop shop to the professionals that are there. The idea being that if all these things are thought out in advance, and the other thing we didn't throw in is if there's a receiver involved, because now we have receivers counsel that needs to opine on all the different documents. But not trying to make it more complicated, Steve. I think it's important to have these things lined up in advance to be addressed proactively.
Dan?
I just want to tell a real quick story about a mandate that I worked on recently. A tech entrepreneur who made a lot of money and became a newbie to the hotel space. I want to own a hotel. Why do you want to own it? I want to hang out with all my friends and whatever. And you want to make? Oh yeah, I want to make money too, type of thing. Anyway, this gentleman won a 10x auction, $40,000 a room for a 20-year-old Courtyard by Marriott. And once he won the auction, the broker said to him, you definitely need a little bit of help here, and introduced him to me. And the guy was all excited. I'm in contract. I'm going to buy this Courtyard for $40,000 a room, and all excited about it. And I just kind of asked him a couple of questions, only to find out that the property is encumbered with a long-term, no-cut Marriott International management agreement, 5% of gross and 20% of gross operating profit. Okay, think about those economics for a second, right? And then when I explained to the gentleman, that's why you only paid $40,000 a room, he was like, oh. Anyway, something to think about.
So, and I'll just add to that, Steve. We're selling a Marriott encumbered hotel right now at the BWI airport. So Marriott's the management company. And there's no termination date. There's no negotiating termination date. It will be Marriott managed till the end of time, or until Marriott says they don't want to do it anymore. But the buyers that are buying it, they're newbies, people that are coming in, and they take solace. They're very happy that it's Marriott managing it, and the hotel does well. It has a lot of cash flow, so it's not always a bad thing. I'm not trying to be the Marriott defender here, but I do think there are situations where it's appropriate.
Doesn't mean they're not leaving money on the table, and I've seen it many, many times.
Oh, sure, no doubt. And they're going to need a qualified asset management company to help them oversee all the things that Marriott is doing.
I'm going to ask Manuel about going apples to apples, but I'm looking at the students for a second. And there's a study period. The buyers put down a deposit, whatever the deposit is. They have a study period. They can, in general, get their money back at the end of study period, but they need to make a go, no-go decision. I'm going to be asking Jennifer and Jonathan about those last days leading up to that decision. First, Manuel, we got apples to apples. You have your client as looking at IHG and Hyatt and Accor. They're looking at Aimbridge and Crestline on management. How are you helping them to evaluate the direction to go?
Yeah, interestingly, I'll touch on the subject of the brand, but we actually ran a management company selection process towards the beginning of 2021 when, what you would normally see as a sophisticated client, which was a bank, but obviously, as we know, banks have zero knowledge and understanding of how the hotels operate, took over the keys to a property in New York, and they obviously needed to determine, do we keep the brand, do we execute a new franchise agreement, and who do we select as our management company? So there's a lot of things that go into who the right player is. There's chemistry. Is this a union versus a non-union operator? That's key in markets such as New York, where if you end up selecting a union operator and your hotel is non-union, they tends to be a higher risk of that hotel becoming a union hotel later down the road. And there's a whole host of factors, including who offers you the best deal in terms of upside for your property. Maybe you strike a low management fee in exchange for a higher incentive if they can get you greater market share. What is the support system behind what they bring to the table? I mean, I think there's a lot of folks here that may be aware that once players like Aimbridge and Interstate integrated back in 2020, which I was part of that transaction back in the day, the big question was, can a big company with 1,000 hotels and plus in management provide the same kind of service as the smaller players, right? And so, those are the kind of things that you need to take into account, the level of support that you'll require. Many owners, especially institutional owners, not institutional owners, but the smaller owners require greater hand-holding. And, a lot of times you don't get that from bigger companies. What kind of back-of-the-house support can they offer in terms of their ability to drive revenue to your property? So, there's just a few of the things that kind of go into selecting the best management company.
It's interesting. I remember when Dave Johnson and Les Bentley founded Aimbridge Hospitality. I think you were part of that, and they started with 4 or 8 hotels.
It was 8 Wyndham Garden hotels.
Correct. And once they launched, the rap against them was, they're too small, and who ever heard of them before, right? Then they got to 1,400 assets. I think now they're down to less than 1,000. That's a different story. But when they got to 1,400 assets, it was like the rap was, they're too big. Who are you going to talk to? So in a way, it's like you're damned if you do and you're damned if you don't.
For a second, going back to expensive money, the management companies will sometimes put in a sliver of equity.
Terrible idea.
Okay.
Horrible.
Terrible idea.
Stupid, you said, right?
Jonathan, go ahead.
It sounds good, right? The operator comes along and says, I will partner with you. If they're putting up 25% or 30% of the equity, they're your partner. If they're putting up 10% of the equity as sliver equity, right, what goes from like a management agreement that's terminable with 2 years of fees just because you decide becomes something that's very expensive to terminate. Right? It's very difficult to get them out because not only do you have to remove them as manager, if you need to, they're in your equity. So you need to figure out, right, what you're going to do vis-a-vis your loan, what you're going to do vis-a-vis the brand in terms of doing a transfer of equity, either replacing them or buying them out. You might not have an easy right to buy them out, so they might technically be your partner and you're trying to get rid of them on the management side. So again, if you're 25, 30% equity, something like that, they're your partner. If they're 5 to 10% of the equity, it's the most expensive money in your entire capital stack when you think about the encumbrances that it puts on you. So it sounds really good. The best thing that we do with independent management companies is we say, we need an at-will termination right, termination for convenience. We're willing to pay a fee. It'll be sliding scale, right? But if we own, and I'm doing this with a Texas billionaire right now on a deal, we're bringing in an independent management company to take over what is currently a brand-managed hotel. And, they gave us a term sheet, and the term sheet said, okay, here's the performance termination. You can terminate this for free on sale. I said, that's great, right? This is a local billionaire. If he decides, like, the day after we close, right, that he doesn't like you, he has to have the ability to terminate you. Now, we have to treat you fairly. Right, you're entitled to a termination, like a good termination fee for that, right? But after several years, after 4 or 5 years, we can terminate you with almost no fee. And basically, every independent management company is generally okay with that because they have to show up and prove their worth, right? They have to prove their worth on a daily, monthly, quarterly, and annual basis to their owners. Whereas if you're stuck with a 30-year or perpetual brand management agreement, they'll tell you like, hey, we passed the performance test. Like, we'll see you at the quarterly budget review. And like
it's harder to keep them accountable. Yeah, and at the end of the day, it goes back to the fact that unencumbered hotels, tend to be more appealing to prospective buyers.
I'm not an attorney. Jennifer, maybe you want to talk a little bit about this. But Jonathan, the scenario that you talked about of brand management putting in equity, isn't that called agency coupled with an ownership interest? And I mean, I don't want to open up.
We have all those cases.
There's a lot of case law on this and a lot of historical litigation.
Exactly. I'm not looking to open up a can of worms. But the other thing, too, is, and you just touched upon it, performance provisions. They are so important. And I love when, we have performance provisions in our agreement. Really? Let me take a look at them. There's no teeth in this. It's meaningless, right? So you really need to look at what are, in fact, if you have to meet 80% of market-wide RevPAR, sure, you can do that all day long, right? But if you have to meet 105% of market-wide RevPAR, that's a...
Yeah, Dan, that's why with independent managers, we always insist on a convenience termination right. We can decide, it may cost us something, and that's okay, but if it's not working, right, if just the chemistry is not there, it could be they're performing. The chemistry is not there. They don't see eye to eye with the owner and the mentality. You need to make a change. You can't just look at someone and say, we kind of don't agree, but we're going to live together for the next 10 years. That doesn't work.
All right, Jennifer.
You also need to deal with them if you want to sell the hotel. It's gonna make that road even harder. But it's the performance termination test and a brand managed hotel management agreement are just absolutely worthless. I mean, people spend a lot of time. You spent more money in the legal time negotiating that provision. You might as well not even have it. But if I don't put it in there, it's probably malpractice. But because you have a 30-year management agreement, whatever numbers you're negotiating in a vacuum. You have no idea what it's going to look like, and they can always buy their way out of it. Which, if they want to keep the hotel, they will. I mean, barring them deliberately tanking the hotel because they want to leave, which nobody would really do, they're worthless. And then trying to get any other kind of termination rights with a big brand is impossible.
Now, Stephen, we didn't address your question about how do you deal with management and brand selection during the study period, right?
Let me jump to study period. We're at September 17th, Jennifer. The study period ends September 27th, 10 days from now. I mentioned PSA, franchise management agreement negotiations, your equity, your debt, all zoning, alcohol. You got a whole list of items. Walk us through what's happening these last 10 days. I'll go to Kyle, Jonathan, Manuel, and Dan. what's happening, and how are you advising your client who has to make a big decision?
Well, most likely at that point, when you're that close, you've gone through all the sort of hard due diligence, like the hard asset due diligence. You've been around the hotel, you've looked at it, you have an idea, you've been talking to the brand if there's a PIP and what needs to be done. You know, I have a deal right now where the understanding was that some of the rooms have been renovated and some of them haven't. And, you know, the buyer thought that the PIP was going to be to renovate the unrenovated rooms, but the brand wants them to renovate even the already renovated rooms because, of course, the brand standards change daily, as far as I can see. So they want them to do that. So having those discussions at the last minute is what you're doing. And then typically you're going back and forth with the lender. At the last minute, it's usually whatever you're negotiating with the brand and the
We're
lender.
going to add 2 more. Jason's going to be on panel 4. We're going to have an environmental attorney on panel 4. You get a problem with an encroachment, an easement you didn't know about, chain of title, and there's a buried, maybe an Exxon station from the 50s on the site, who knows? You're going to get something that's surprising.
We have that right now. There's the pre-development, someone has a right of first refusal on to build a parking lot, but it's a fully developed hotel in New York. It's a permanent right of first refusal. It's on title. You want it or not. I mean, there's nothing I could do. Unless you're planning to knock the hotel down and build a parking garage in its place, which I do not think anybody is doing, you just have to close over it.
So it's on the title and runs with the property?
Yep.
I've never heard of that.
Yep, it's been there for forever.
Yeah, if it's there and recorded, it's a matter of record.
Right, but everybody sort of looked the other way, at the time when they were building a hotel because they're like, we're building a hotel here. We're building a huge big box hotel. We're not going to knock it down and build a parking
I'm
garage.
going to continue with Jonathan on this, then Kyle, but for Manuel and Dan, we rarely talk about the other service providers, preferred hotels, who can offer reservation systems. Do you engage them? But first, let's continue on the path to acquisition.
So
Jonathan?
path to acquisition. So I've also got a real world one. I have a project. It's a full service hotel, brand managed. Right, needs a big renovation. We're converting it from brand managed to independent managed. The brand is changing, but the brand family is not changing. So we're getting a lot of cooperation from the brand, and we're going to do a huge PIP. Right, we're going to do a PIP plus a bunch of offensive CapEx on top of it, so the brand is happy with us. When we started on the diligence process and started our study period, we already knew what our intention was in terms of change of brand, and we had already identified the management company, the independent management company, will be either A or B, right? Because we would not have enough time and not have enough information at the start of the study period to run an effective RFP process, right, that could take several weeks. Instead, we wanted the management company to be assisting us during our due diligence process, reviewing the documents, reviewing existing performance, upside, our pro formas and models in real time. So, at the end of our study period was September 2nd. We extended it 1 week, not because we had an issue with the brand or management. We had a deal with the brand. The application for the franchise is going in today, and the PIP is done. We had a term sheet with the management company and the hotel management agreements in place. What slowed us down was the third-party property condition reports, right? It's an older hotel. So we engaged not just a phase 1 and a property condition report, but an owner scope report on all the mechanical systems, on elevators, on plumbing, on HVAC, on roofs. Instead of we did the sort of typical PZR kind of zoning permits land use report, but we engaged an outside firm to do a detailed fire life safety review, to make sure not only were we going to be compliant, or what do we need to do to be compliant with code, what do we need to be compliant with the brand, whose fire life safety standards are stricter than the local building code. And so we got our reports back, and mostly no kind of earth-shattering issues, but because it's an older hotel, they identified some stuff. We were carrying budgets, and we said, hey, we need an extra week or 10 days because we want to send in some contractors to vet these numbers, right? And so we went hard with less than our full deposit last week, and on Friday we'll go hard with the rest of our deposit because we got our contractors in last week to vet the numbers and get us comfortable that our CapEx budgets and numbers are kind of in line. But that was the last thing holding us up, and it's really the third-party process.
Kyle, you have a, go ahead, Dan.
Just jump in for 1 second on the third-party process. So we do a lot of valuation work, appraisals. I will tell you that there are lots of valuers out there that have stayed in a hotel during their lifetime, so they're hotel experts, right? They also value muffler shops and car dealerships and things like that. Anyway, everybody knows that hotels are very complicated, sophisticated assets, and really specialization. It doesn't matter what you do as a service provider, as an attorney, what I do, whatever. There's something to be said about specialization. Anyway, my point is, we have a number of clients who retain us before making any deals with lenders, what have you. They'll spend $15,000 to get an appraisal done, knowing fully well that whatever lender they end up working with will not be able, most likely, will not be able to accept a borrower-engaged appraisal. They know that going in, right? What they also know is that the lender, who also probably doesn't understand the hotel business and has a appraiser list that they pick from that's populated by those folks who stayed in a hotel once during their lifetime, right? The sponsor has no input at all on who does the valuation. And I've seen deals blow up because the value didn't, support the loan request, right? We do an appraisal. Part of the due diligence dump that the sponsor does for the ultimate appraiser who's selected, they put down an LW hospitality report. It's part of the due diligence dump, right? Sets a marker in the ground. So just something to think about vis-a-vis engineering environmentalism.
I'll give Dan a plug, but it's not really to give Dan a plug, right? So
the check cash, good.
His appraisal is going to be 250 pages, right? It's going to have a whole bunch of background information on the market. It's going to have identification of the comparables and sort of how the subject property compares to them, sort of what the more unique characteristics of the property are, and how that gets dealt with, right? Whether there's a ground lease, there's an extra garage, how many F&B outlets they have. So, an unsophisticated investor who is looking at an appraisal is going to look at the first 2 pages and say, oh, the as-is value is this, and the DCF is this, and sales comps are this. A sophisticated investor is going to read through, they're not going to care so much about the pictures, and they're not going to care that much about the staff bios in the back, but they're going to read through the market, the sub-market, the comps, what's going on, because every one of those pages is going to give you some additional information, right, to think about in your underwriting and think, are these really the right comps? Is this who I was thinking about? Why? What is there are a whole bunch of very informed estimates as to what the comps are doing in terms of business mix. How much transient, how much group, how much leisure transient, business transient, to much better understand the competitive set, much better understand if those are the right comps relative to the STAR report, the Smith Travel Research report that the property was using and gave you, which may be great, may be garbage. Maybe absolute garbage.
Kyle, you're representing a seller. They have an operating hotel. They're trying to generate revenue, whether the deal goes through or not. Hopefully the deal goes through. You have inspectors coming, engineers coming. The buyer is asking the seller for certain documents. When was the last time the elevators were serviced, the roof repaired or renovated? What is your role in helping guide the process with an operating 24-hour property?
So we're always trying to maintain the integrity of the ship, as I put it. We want the hotel, first and foremost, to continue to operate. It's in the best interest of everybody, buyer and seller, and we want as minimal disruption as possible. So to the extent the seller can gather that information without alarming the staff. Every time we go to the property, the staff is on alert. Every time an inspector comes, the staff is on alert. So we try to make sure that the disruptions to the ship are as minimal as possible. And sometimes at a certain point, staff figures it out. Okay, we're going to be sold. Do I have a job? Everybody's worried about their future. So we recommend often to the seller to go to the staff proactively and don't have them come to you and say, are you selling my hotel? You know, am I going to lose my job? Instead, tell them that everyone here is important and everyone is needed by the new buyer. So think of it as you're on display, and this is your chance to prove and to shine how great a staff we have.
Manuel, we haven't talked about, well, I mentioned preferred hotels, but we haven't talked about architects or designers. Are you engaging consultants or designers who say, you know, we could really do an interesting lobby restaurant or lobby design? Are you helping your clients think through what could be with the property?
I mean, we certainly do. At the end of the day, you know, given that all of these other specialties are not our area of expertise, you know, more often than not, especially new owners that have no experience with hotels will come to us if we get hired, ideally early enough in the process, and they will ask, well, you know, walk us to what the you know, the process looks like. You know, who should we engage? And there's obviously firms that we have worked with in the past, you know, call it preferred vendors that you could always name. And it goes from architecture, design, you know, development, management companies, et cetera, et cetera. But, you know, at the end of the day, we kind of laid out the cards on the table for the owner, give him our recommendations, and ultimately, you know, try to you know, sway the owner one way or the other based on our feedback, but ultimately is the owner's decision. Something I wanted to add to some of the processes that we have touched upon earlier is, I think once you get to finalizing the acquisition of a property, one key component that we haven't touched up is on the actual transition of operations, which can completely derail the start of a new, you know, management process for the buyer if not done properly, right? So as much as we have mentioned a lot of the challenges in securing the right management company for the various reasons, I think it's also key that there's a very strong relationship with them when it comes to, you know, conducting the transition with the new manager that will come in, assuming the incumbent is not able to relink the contract with the new owner, because there's you know, transfer of employment for most of the staff. There's prorations of a number of items that, if not done properly, you know, can create a headache well into the new management process. So I think that keeping an eye on having a smooth transition is key to ensure that the acquisition, you know, it goes well on both sides.
We spend very little time on that. It's such a great point. Maybe the last comment, because we're heading towards a break. Jennifer, you want clients who pay you your fees. We get that. What makes, and maybe if we have time, go down the line, what makes for a good client? Do you want someone participating, someone not participating, someone quick to respond?
Participating.
What makes a good relationship?
Definitely participating. I mean, you know, I have one client that I referenced earlier who's a newbie who has no clue what's going on, no clue. And, you know, you can't assume that, you have to assume that they know absolutely nothing. And some of the things, you know, in hotel land that are sort of more like, well, you're dealing with Marriott, so this is the way it goes, unfortunately. It doesn't resonate with them. They don't get it. Versus, on the other hand, another deal that I'm working on has a very strong in-house asset management team. So when we're going through the PSA and talking about the prorations, they are very, very in tune with every single dollar and every single item on those prorations. And we spend hours on the phone going through the proration. So they're not leaving any money on the table. And if they are, they know exactly how much is being left on the table. So for me, it's a far better engagement if the client is sophisticated and knows what's going on.
Okay, let's go down the line. We'll end up with Kyle. Jonathan, same question. What do you value in your clients? Or anything else you want to say as we leave?
So I'll do the one other thing quickly, and that is you started talking about architects and and designers. One of the issues I deal with a lot is people from outside of the industry, high net worths. They have their own ideas about what architect they like and what interior designer they like and what they want to do, and it's usually totally divorced from the reality of how a hotel operates, right? So the $15,000 chair that they have in their fourth home somewhere in ski country is not going to sit in a hotel room, right, that's going to have 75% occupancy, and the specialty white fabric, right, is that's going to get stained in the first week, isn't it? So
Unless you're Ian Traeger.
well, Ian's designs today look.
Yeah. All right, we need to go down the line. Okay, Manuel, we get it. Manuel.
God.
Yeah. It's a whole different conversation. It's panel 5. Go ahead, Manuel. Anything you'd like to add, or what do you value in your clients?
I think that at the end of the day, our role with respect to advising our clients is heavily focused on due diligence, which we already addressed, but more so on the asset management side, in making sure, as it was mentioned, that really no money is left on the table, but more importantly, that you mitigate any risks associated with the buying and the operating of a hotel, which it's a very complicated asset.
Dan, I'm going to switch the question. What do you value from your professional colleagues, including the panelists up and down the line? What do you value?
I don't know. I was already prepared to talk about clients. So
okay, go ahead. Talk
I'll
about
answer
your
that one, but this is really important in my humble opinion.
Go ahead.
Right? We like to work with clients who respect what we do and consider what we do. They may not listen to it. We have a client who just opened up a branded hotel who originally started working with this gentleman, made a lot of money in the insurance business, typical newbie, right? 2006 is when I started working with this individual. The hotel just opened up recently. He's never listened to anything I've ever said. That's okay. He pays my bill, which, by the way, is an important thing, right? I'm a professional service provider, just like everybody else, I think, in this room is, right? And I'm not a lender. I don't extend credit, right? So my philosophy is I want to get paid for my time. And candidly, unless you're a federally insured lender, we always get money up front. And we're happy to work on a phased basis as long as we're always ahead of a client. And because, again, we're not set up to collect receivables. And I love when, again, highest level of respect, but when law firms want to retain us, and I need a guarantee. I need a bankable guarantee, because the last thing I'm going to do is sue a law firm to collect fees, right? What about my colleagues here? They're all great.
Okay, good. There we go. I'll take a personal moment. My freshman year in college, I was in Darnell 1 with Kyle Stevenson down the hallway. Kyle was in banking. I remember working in banking, and now we've been working together. These things are powerful as part of my aging process. Kyle, any last thoughts for us?
I would say, from a client perspective, I ask them, I give a little speech as we're getting started in the process and remind them that what's important is to communicate and decisions. We need to make decisions. This is going to be a process where there are going to be a lot of things we have to decide, and the longer it takes to make those decisions, the more likely the deal doesn't happen.
Thank everyone from the panel.
Ladies and gentlemen, thank you very much. Got a couple of closing remarks I'd like to just provide everybody and give some thanks to our folks. So a big thank you to all of our supporters. As you see on the screen there, we literally could not do these programs without you, so thanks to all of our supporters. Thank you very much. And then can we give a round of applause to all the panelists that spoke this morning? That was great. And how about a big round of applause to Stephen Shapiro, moderator extraordinaire. And we're going to clap even though he's an Orioles fan. And I'd like to say thank you to the Army-Navy Country Club. I think they did a terrific job as always, so thank you guys. If you're so inclined, we'd love to see you at our program in May 13th and 14th in Houston. So ladies and gentlemen, we're going to have some last moments to say thank you for joining us.
As stated during the beginning of this presentation, the link to initiate the certificate process will be displayed momentarily. My Law CLE would like to thank you for your participation in today's presentation.